The artificial intelligence market is consuming massive amounts of hardware right now. Micron Technology just dropped their latest revenue numbers, and the data is completely staggering.
Revenue is up 196%. Their high-bandwidth memory production is completely sold out through 2026. Every single factory they have is running at absolute maximum capacity.
People look at this financial growth and make a massive assumption about the future of the company. That assumption is totally false. Micron will not be the next Nvidia. We are going to look strictly at the underlying business reality to see exactly why.
We are viewing this strictly through the logic of value investing. You have a hardware company making massive revenue with profit margins over 70%. Yet Wall Street gives this company a valuation multiple strictly below 10. The rest of the semiconductor industry sits way up at 30. The market is sending a very clear message about the actual long-term quality of this business.
The reason for this massive gap in valuation comes down to the business models. On one side, we have a standardized hardware component supplier. On the other side, we have a software platform standard. These are entirely different financial realities.
A component supplier faces an absolute hard limitation. They just make the basic physical parts needed to turn a machine on. The end user never actively interacts with these parts. They sit completely hidden away inside the server. It is strictly a physical necessity and nothing more.
This creates a stark contrast in human behavior. Having memory hardware installed is a completely passive necessity. Using a software platform, however, is an active dependency. Developers do not care at all about the physical memory chips inside the computer. They care deeply about the software programming environment they log into every single day.
This dependency forms through a strict logical progression. A company buys the hardware system. Then, the developer spends hundreds of hours learning the software environment. They write and accumulate massive amounts of code on that exact platform. Complete ecosystem lock-in is eventually achieved. Leaving becomes mathematically and financially impossible.
This software layer acts as the ultimate delighter for the user. Developers do not just tolerate these programming platforms, they actively crave them. The architecture makes their daily work seamless. They build their entire professional careers around these specialized coding environments. This daily joy of use generates a massive, unshakable psychological reliance.
This brings us directly to the reality of substitution risk. A hardware component supplier faces instant customer defection. A software platform owner enjoys total immunity to price wars.
Look closely at the global high-bandwidth memory market. It is controlled by exactly 3 companies producing identical physical components: Micron, Samsung, and SK Hynix. If Samsung or SK Hynix offers a price reduction of even a fraction of a cent, the customer will instantly shift their entire order away from Micron.
There is absolute zero brand loyalty in pure hardware components. The customer only cares about the technical specifications and the final price tag. The supplier is completely interchangeable at a moment's notice. This dynamic creates severe economic consequences. The hardware supplier is permanently vulnerable to external supply cycles. The software platform owner maintains unshakable long-term pricing power.
We can deduce the platform owner's pricing power logically. Think about the developer who spent hundreds of hours learning the system and accumulating millions of lines of code. The financial cost for a business to rewrite all that code and retrain their staff far exceeds any price premium the platform owner decides to charge. Therefore, the platform owner dictates the price and the customer happily pays it.
This defines the final trajectory of their respective structural advantages. A hardware manufacturing advantage is completely static. It does not improve simply because more people buy the hardware. A software platform benefits from a dynamically expanding network effect. Every single new developer who joins the ecosystem makes the platform exponentially stronger and much harder to leave.
The harsh reality of the component supplier model becomes extremely clear. They are highly sensitive to price drops. They face instant customer defection. Their current extreme profitability is solely the byproduct of a temporary global supply shortage. Their long-term profits are dictated entirely by external market forces.
This fundamental lack of a software defense brings us right back to the start. It is the exact reason the capital markets refuse to assign a valuation multiple higher than 10 to the hardware supplier.
The market clearly recognizes that extreme profits without ecosystem lock-in are always temporary.
The final value investing verdict is absolute. Platform ecosystem owners continuously expand their dominance through deep user lock-in. Interchangeable component suppliers will always remain vulnerable to the brutal cycles of supply and demand. They simply exist in entirely different financial realities.
The next time a hardware company posts record profits, you need to look closer. You must determine if you are looking at a permanent structural advantage or just a temporary supply shortage. The above content represents only a deep deconstruction and analysis of business logic and does not constitute any form of investment advice. The market carries inherent risks, so please make sure to conduct your own independent research before making any decisions.